All right, so we're diving deep today.
Deep diving.
Yeah, into year-end tax tips.
Oh, yeah?
Using this CIBC guide on 2024 tax moves. And
Lots to cover.
I know. There's so many strategies in here. It's amazing.
Yeah.
Whether you're an investor or homeowner, have a family.
Business owners.
Yeah, business owners. It's got it all.
It does.
So we're going to try to uncover some smart moves here.
Uncover.
That can potentially, save you some money on your taxes.
Yeah, definitely.
And maybe even reveal some opportunities that you hadn't even considered.
Exactly. We're going to cut through all that noise and focus on what matters.
What matters to your bottom line.
Right.
Perfect.
All right.
So investors out there.
Yes.
Capital gains tax changes, that's a hot topic this year.
Yeah. Big changes.
Big changes. The inclusion rate went up this year.
It did, yeah. It's up to 66.67% now.
Okay.
But there's a little silver lining.
Oh.
For the first $250,000 of capital gains, you're still taxed at that 50% inclusion rate.
Okay. So there's actually a benefit to selling investments.
Right.
Even if they're doing well?
Yeah, potentially.
That feels kind of counterintuitive.
It does, yeah.
To sell something that's, making money?
But with that lower rate,
right,
on that first $250,000,
yeah,
it opens up this strategy called tax gain harvesting.
Tax gain harvesting, okay?
And that's essentially selling investments to lock in those gains.
At that lower rate.
At that lower rate.
Okay, and then you immediately buy back the same investment.
You do. You buy back.
Isn't that a lot of work for nothing?
Not really. It's
okay.
It's like a little shuffle.
Oh.
You're crystallizing the gain.
Oh, right.
To take advantage of that lower rate.
Okay.
But you're maintaining that position.
So I'm not missing out if it keeps going up.
Exactly.
Okay, but what if it goes down right after I buy back in?
Well, that's a risk, right? You got to consider that.
It's not a foolproof plan.
Nothing is.
Right.
It's not about timing the market.
Yeah.
It's about managing your tax liability.
Okay.
So if you're worried about those short-term fluctuations,
right,
this might not be the best.
Okay.
But if you've got a longer-term outlook,
right,
and you believe in that investment,
believe in it,
it could be worth exploring.
Okay, so it's about looking at the big picture.
Big picture.
Of your whole portfolio.
And your risk tolerance.
Okay, makes sense.
Makes sense.
All right, let's shift gears a bit.
Okay.
To something a bit more familiar.
Okay.
Tax loss selling.
Ah, yeah.
It's a classic move.
The flip side.
Yeah, the flip side of tax gain harvesting.
Exactly.
So instead of selling things that have gone up, we're selling things that have gone down. Yeah.
Yes.
To offset any gains.
To offset the gains.
That we made throughout the year.
Exactly.
To reduce our tax bill.
That's the goal.
It's a classic move.
It is a classic, but...
Now I remember. Yeah. It's December 30th now.
30th, right?
That's the last day to sell.
To settle.
To get it settled, yeah.
For the 2024 tax year.
Right, because of that T+1.
T+1, yeah.
Settlement change.
Big change.
Okay, but now foreign currencies.
Oh, yes.
That's where it can get a little tricky.
Tricky.
I remember reading in the guide about this guy, Jake.
Oh, poor Jake.
Poor Jake. He tried to harvest a loss.
He did.
But he forgot about the exchange rate.
The exchange rate gets you every time.
So even though his stocks went down in U.S. dollars. When he converted it back to Canadian.
That's Canadian.
He ended up with a gain.
A gain, yeah.
So instead of saving money on his taxes, he ended up owing more.
It happens.
It happens more often than you think.
So pay attention to those currency fluctuations.
Especially with all the volatility lately.
Yeah, right. Okay, and then there's the superficial loss rule.
Oh, yes.
Where you sell something at a loss. And then buy it right back.
30 days.
Within 30 days. The CRA knows that one.
Yeah, they're wise to it.
They are.
So you can't claim that loss.
No, you can't.
The same goes for transferring to a registered account.
RRSP, TFSA, no.
Yeah.
Doesn't work.
You got to sell, wait, and then maybe buy back later.
Exactly.
Okay, no loopholes there?
Nope.
All right. Let's move on.
Moving on.
RRSPs and TFSAs.
The workhorses.
Yeah, the workhorses of retirement planning.
Always good to review.
Especially as we're approaching the end of the year.
End of the year.
We got until March 3rd.
March 3rd, 2025.
2025.
To make that RRSP contribution.
Right, to make that contribution.
The sooner, the better.
The sooner, the better.
More time to grow.
More time to grow tax deferred.
Tax deferred, right?
TFSAs, no deadline there.
No pressure.
No pressure, just whenever you have the money.
Exactly.
Okay, what about withdrawals from these accounts?
Withdrawals?
Any strategic moves there?
Well, if you're thinking about tapping into your RRSP,
right,
home buyer's plan,
or the lifelong learning plan,
Delaying those withdrawals until early 2025
Yeah.
could push back your repayment obligations.
Give you some breathing room?
A whole year.
A whole year, okay.
Yeah.
What about TFSA withdrawals?
Withdraw before the end of the year.
Okay.
Get that contribution room back.
At the beginning of next year?
Beginning of next year.
Perfect, okay.
Yeah.
Now, for those 65 or older...
65 or older.
There's something in here about converting part of your RRSP...
To RRIF.
To a RRIF. What's the advantage there?
Well, if you don't have any other pension income...
Okay.
Transferring $14,000 from your RRSP to a RRIF...
Okay.
Lets you withdraw up to $2,000 per year, tax-free.
Oh, wow.
Thanks to that pension income credit.
It's like a little bonus.
Nice little bonus.
Okay, that's a good one to remember.
Good one.
And for those turning 71 this year,
There's one.
got to convert that RRSP.
To a RRIF or a registered annuity.
No more putting it off.
No more putting it off.
That deadline is coming.
It is. But
If you have some earned income in 2024,
earned income.
You could make a one-time over contribution.
Before converting,
you
will have to pay a penalty.
A small penalty.
Small penalty.
Okay.
But it might be worth it.
To reduce that tax bill.
Especially if you're in a higher bracket.
In a higher bracket this year.
Yeah.
Okay, that's an advanced move.
A bit advanced.
Talk to your financial advisor.
Definitely.
Okay.
Yep.
Lots for investors to think about.
Lots to think about.
So let's move on to home buyers and owners.
Home buyers.
There's been a lot of talk about the FHSA, First Home Savings Account.
First Home Savings Account.
What's the deal with that?
It's a fantastic tool for those first-time home buyers.
Right.
It combines the tax deduction of an RRSP with the tax-free withdrawals of a TFSA.
When you're buying a home.
When you buy that home.
So it's the best of both worlds.
The best of both worlds.
That's amazing.
It is.
I see the contribution limit is $8,000 a year.
$8,000 per year.
Up to $40,000 lifetime.
That's right.
Okay, but what's really great is if you decide not to buy a home,
you can transfer.
You could just transfer it.
To an RRSP or a RRIF.
No tax consequences.
Not at all.
It's a win-win.
A win-win.
I love it. Okay.
Yeah.
Let's talk about renovations.
Renovations.
Are there any tax credits?
There are a couple that are worth mentioning.
Okay.
First, there's the Home Accessibility Tax Credit.
The HATC?
The HATC, yeah. That helps seniors and people with disabilities.
To make their homes more accessible.
More accessible.
Okay, so you can claim 15% of eligible expenses.
Up to $20,000.
So that's potentially a $3,000 credit.
That's a good chunk of change.
It is. Okay, what about that new credit for multi-generational homes?
Oh, yes, the MHRTC.
Yeah, MHRTC.
The Multi-Generational Home Renovation Tax Credit.
Catchy name.
Yeah, very catchy.
So this is for homeowners.
Homeowners creating secondary units.
For their family members.
Family members, yeah.
Okay, and this one is a refundable credit.
Refundable?
Of 15%.
15%.
Of expenses up to $50,000.
So
$1,500.
Wow, that's a big one.
That's a big credit.
It is.
Okay, so who are these family members?
So we're talking about parents, grandparents, children, grandchildren, siblings,
uncles,
aunts, uncles, nieces, nephews, the whole gang.
The whole gang.
Whole family.
Okay, and the renovation.
The renovation.
It's got to be a self-contained unit.
Self-contained.
With its own entrance.
Veterans kitchen. Bathroom, sleeping area.
Okay, so a proper unit.
Proper unit.
Okay, it sounds like a great way to support family.
Support family.
And add value to your property.
And add value.
But are there any downsides to this credit?
Well, one thing to consider.
Okay.
Claiming the MHRTC might affect.
Affect what?
Your ability to claim the principal residence exemption.
When you sell your home.
So
you might end up paying more capital gains tax.
You might.
So it's really about weighing those long-term implications against that immediate tax saving.
Exactly.
Okay, and you can't double dip.
No double dipping.
If you've already claimed medical expense tax credit.
Or the HATC.
Or the HATC, yeah.
For the same expenses.
Okay, you can't claim both.
You can't.
Got it, no double dipping.
No double dipping.
Okay, let's move on to families with students.
Students, RESPs.
Always a popular topic.
Always popular.
Especially this time of year.
This time of year.
Got to make sure you're maximizing those RESP contributions.
Yeah, to get that grant.
That CESG, that Canada Education Savings Grant.
Yeah, free
money for education.
Who doesn't love that?
Exactly.
So, are there any deadlines to keep in mind?
There are a couple of scenarios where timing is important.
Okay.
First, if your child turned 15 this year.
Okay.
And they've never had an RESP.
You need to contribute at least $2,000 by December 31st
To be eligible.
to be eligible for future grants.
Okay. That's a hard deadline.
Hard deadline.
Okay.
And then there's the catch-up contributions.
Catch-up.
So each beneficiary can have up to $1,000
of CESGs paid
in annually,
Okay.
with a lifetime limit of $7,200.
$7,200.
Up to the year they turn 17.
17.
So if you haven't maximized those contributions, and you've got less than 7 years before they turn 17,
Better get on that.
better get on that.
Before December 31st?
December 31st.
Okay. Lots of deadlines here.
Lots of deadlines.
What about withdrawals from our ESPs?
But there's a few strategies there.
Well, if your child's in post-secondary,
Yeah.
consider withdrawing those EAPs.
EAPs.
Educational assistance payments before the year ends.
Okay.
Might not have to pay any tax.
Oh, that's good.
If they have enough personal tax credits.
Okay, and what if they finish school this year? You've got up to 6 months after they leave
To make those withdrawals.
Okay,
so again, it's about timing.
It's all about timing.
Those withdrawals just right.
Just right.
Okay. All right. Now let's look at families with members who have disabilities.
Okay.
RDSPs.
RDSPs.
These can be so valuable.
Incredibly valuable.
Tax-deferred growth.
Tax-deferred growth.
Government assistance.
Through grants and bonds.
Grants and bonds, right? The contribution limit is $200,000.
$200,000.
And you have until they turn 59.
It's 9.
To make those contributions.
That's right.
Okay. And the government might contribute up to
$3,500 in grants.
Okay.
And $1,000 in bonds.
Each year. Each year, yeah.
That's a lot of support.
A lot of support.
Okay, but there are income eligibility requirements.
There are.
And remember, those grants and bonds...
They're only available until the beneficiary turns 49.
49. So if you haven't started contributing...
Better start now.
Yeah, don't wait.
Okay, now what about those with a shortened life expectancy?
Ah, yes.
Are there any special considerations for them?
There is a special rule that allows for withdrawals up to $10,000 per year.
Per year.
Without having to repay those grants and bonds.
Okay, that's great, but
there's a catch.
There's always a catch.
Always a catch.
What is it?
You have to file an election with the CRA.
By December 31st.
December 31st.
Of course.
To take advantage of this.
Okay, another deadline.
Another one.
To keep in mind.
Keep in mind.
All right, we've talked a lot about tax credits.
Tax credits.
But there's also the medical expense tax credit.
Oh, yes, which
can be a lifesaver.
Yeah, for many families.
Many families.
Remember, you can claim those eligible medical expenses.
Paid during any 12-month period.
Any 12-month period.
Ending within the calendar year.
Okay.
So.
And there's that 24-month window.
24-month window.
Claiming expenses.
If someone has passed away.
Okay, so take the time.
To review those.
Review those records. Okay.
Now, before we move on.
Yeah.
To individuals with changing tax rates.
Okay.
We got to talk about the AMT.
Oh.
The alternative minimum tax.
The AMT, a bit intimidating for some?
It can be.
Yeah.
It can be.
So who should be worried about this? Okay. Well, if you have significant capital gains.
Okay.
Stock options, dividends.
Or certain tax credits?
For certain tax credits.
You might find yourself in AMT territory.
You might.
Okay.
And changes for 2024 could result in a higher AMT burden.
Higher burden.
Especially for those making large charitable donations.
Okay, so keep that in mind.
Keep that in mind.
As we approach year-end. Speaking of charitable giving.
Oh, yes?
Any year-end strategies.
There are.
To maximize those benefits.
Absolutely. End of the year.
End of the year.
Prime time for giving.
Prime time. And
depending on where you live, you can get a combined federal and provincial tax credit of up to 55%.
Of your donation.
That's
pretty generous.
It's generous.
Okay, and December 31st. Deadline.
To get that tax receipt.
For 2024.
Okay. Any other tips for making the most of this?
Well, if you have appreciated securities.
Okay.
Donate them directly.
Instead of selling.
So
you avoid that capital gains tax. It's a win-win.
Win-win for everyone.
I love it.
Yeah.
Okay, what if I haven't decided? Which charity to support yet?
Well, there's the Donor Advised Fund.
Okay.
Or DA.
AF, yeah.
You can make that donation.
Yeah.
Get the tax receipt right away.
Okay.
And then decide later.
Okay.
Yeah.
So you can be strategic. With your giving.
Exactly.
All right, we've covered a lot of ground here.
We have.
From investors.
Homeowners. Families. Even a bit about charitable giving.
A bit of everything.
Before we move on
Yeah.
to those individuals with changing tax rates, we need to take a quick break.
A quick break.
We'll be back in a flash to continue our deep dive.
Deep dive continues.
Into these year-end tax tips.
More to come.
Okay, so we're back and
Back at it.
Yeah, ready to tackle a scenario that I think a lot of people might be facing.
Okay.
Changing tax rates.
Yeah, changing tax rates.
This is especially, I think, relevant for those nearing retirement.
Right.
Or those who are, maybe anticipating a big influx of income.
Like a good influx, yeah.
Yeah. So
it all comes down to understanding that
yeah.
if you anticipate some shifts, income shifts in the coming year,
okay.
you can actually make some moves now
okay.
to maybe minimize that overall tax burden.
Okay, so for example, let's say my income was lower this year in 2024.
Okay, lower in 2024.
What kind of moves are we talking about?
Well, in that case, you might want to consider pulling some of those income-generating events into 2024 while you're in that lower tax bracket.
Okay, so
think about selling investments that have capital gains, exercising stock options, maybe even taking bonuses this year rather than waiting until next year.
So you're basically saying accelerate that income.
Accelerate it.
Into the year when it'll be taxed at a lower rate.
Exactly.
Makes sense.
Makes sense.
But what if I'm expecting my income to drop in 2025?
Okay.
Let's say I'm planning to retire.
Planning to retire, yeah.
What then?
Then you'd want to do the opposite.
Okay.
You'd want to defer as much as possible.
Okay.
Hold off on selling those investments.
Yeah.
Delay those stock options.
Right.
And if you're a business owner, maybe push back some bonuses.
Okay.
Or dividend distributions.
So again, it's all about timing.
Timing.
Right.
It's all about timing.
Okay. All right. Now let's move on to our final area of focus here.
Okay. Final area.
Business owners and employers.
Business owners.
Yeah. This is where things can get
a little more complex.
A little more complex. Yeah.
A little bit.
So one of the first decisions I think that business owners often face is how to take their compensation.
How to take it.
Salary or dividends?
Salary or dividends, big question.
It's a big question, yeah, because that decision has big implications.
Big implications.
For both the business's taxes and the owner's personal taxes.
Absolutely. So there's a trade-off there.
Yeah.
You got to consider.
Okay.
Salary gives you that RRSP contribution room.
Okay.
But it's taxed at a higher rate.
Right.
Dividends, on the other hand, lower tax rate.
Okay.
But they don't boost your RRSP contributions.
So how do you decide?
Well, there's no easy answer.
Okay.
It really depends on your individual situation and your goals.
So what's a common approach?
A common approach is to take enough salary to max out
both your RRSP and your TFSA contributions.
Okay.
And then leave the rest.
Leave the rest.
In the corporation.
Okay.
Benefit from that tax deferral.
At the lower corporate rate?
At that lower rate.
Okay, so it's about finding that sweet spot.
Sweet spot.
Okay, now corporate loss planning.
Corporate loss planning.
This seems to be a bit of a minefield.
It can be.
If your corporation has, unrealized losses in its investment portfolio, is there a way to kind of leverage those strategically?
Well, there's a potential strategy involving the capital dividend account or CDA.
CDA, yeah.
So think of the CDA as like this notional account.
Okay.
It tracks the non-taxable portion of capital gains earned by the corporation.
Okay.
And you can use this account to pay out tax-free capital dividends to shareholders.
Okay, so that sounds pretty good.
Sounds good, right?
Yeah. But how do unrealized losses come into play?
Well, here's the thing.
Okay.
Realizing those capital losses
will actually decrease your CDA balance.
Oh, okay.
So that means you might not be able to pay out
as much in those tax-free dividends.
Exactly.
Okay, so the takeaway here is distribute any capital dividends before realizing those capital losses.
Before those losses, yes.
Okay, so get those dividends out first.
Get them out.
Before things go south.
Exactly.
Got it. Okay.
Now, if you've got multiple corporations within a group, there might be opportunities to consolidate losses.
To reduce that overall tax burden?
Reduce that burden, yeah.
Okay, but this is
complex.
Complex, yeah.
Definitely need to talk to the professionals.
Tax and legal advice is crucial here.
Absolutely.
Okay, now what about business transition planning?
Business transition planning.
What if a business owner is thinking about selling their business?
Well, if the business has seen a decline in value, this could be a good time to look at things like an estate freeze.
Estate freeze.
Or a refreeze.
Refreeze. Okay, those sound a bit complicated.
They can be.
Can you give me like a simplified explanation of what those are?
Sure. So essentially, these strategies are designed to transfer ownership often to the next generation.
Okay.
While minimizing the tax hit.
Oh.
So, for example, with an estate freeze, the current owner exchanges their shares for fixed value preferred shares. Okay. So they're freezing their stake.
At the current value.
At that current value.
Okay.
And then growth shares are issued to the new owners.
Which
usually family members.
Usually family. Okay.
So they benefit from any future appreciation.
Okay, I see how that works.
It's a way to minimize those future tax liabilities.
Right, but as you said, the details can get pretty technical.
They can.
So definitely talk to a tax advisor.
Always good to talk to an advisor.
Let's see if it makes sense for you.
Exactly.
Okay, let's talk about income splitting.
Income split.
Something I think a lot of business owners are interested in.
Yeah, but it's a bit of a gray area.
Gray area. Why is that?
Because of those tax on split income rules.
TOSI.
TOSI, yeah, you got it.
Yeah.
These rules are meant to prevent shifting income to family members
who are in lower tax brackets.
Exactly.
To reduce the overall tax bill.
That's the idea.
Okay, so how do these TOSI rules actually work?
Well, essentially, if a family member receives dividends from a corporation and they're actively involved in the business or they hold a significant amount of equity, those dividends could be taxed at the highest rate.
Even if they're in a lower bracket?
Even if they are,
Okay, so just gifting shares
that's simple.
To a spouse or kids isn't always the answer.
Not always, no.
Okay, you really need to understand
those rules.
Those TOSI rules.
Talk to your advisor.
Yeah, and make sure you're not
triggering any unintended consequences.
Yeah, okay, all right. Let's delve into another key issue here for business owners.
Okay.
Passive investment income.
Passive income.
Yeah, this can have a big impact.
Big impact.
On the small business deduction.
On the SBD.
The SBD, right.
Right, so the SBD, it's a valuable tax break for Canadian-controlled private corporations.
Okay.
Or CCPCs.
CCPC.
Yeah, and it can significantly reduce
that tax rate.
That corporate tax rate.
On active business income?
Active business income.
But there are limits.
On
that passive income.
Passive income, yeah.
Okay, so there's a threshold.
The threshold.
For passive income that corporations need to be aware of.
Exactly.
Okay, what is it?
For 2024, that threshold is $50,000.
$50,000.
And once you exceed that, the SBD is reduced by $5 for every one...
Over the limit.
Over the limit, yeah.
Okay, and if it hits $150,000...
You lose it entirely.
You lose the whole thing.
The whole SBD.
Okay, so exceeding that threshold can have a big impact.
Big impact.
What can business owners do?
What can they do?
To manage that passive income?
Well, you can adopt a buy and hold strategy with your investments.
To defer those capital gains.
Defer those gains.
Keep it below the threshold.
Below the threshold. Or invest through things like individual pension plans.
IPPs?
IPPs, yeah.
Okay.
Or corporately owned exempt life insurance.
Okay, so the income...
The income generated within those plans doesn't count as passive income.
For the SBD.
For the SBD.
Okay, so there are ways to structure things strategically.
Strategically.
To keep that SBD.
Keep that SBD.
Now, what about selling a business?
Selling a business.
Are there any incentives?
There are a couple of new incentives worth highlighting.
Great.
First, there's the Canadian Entrepreneurs Incentive.
The CEI?
The CEI, yeah.
Okay.
Which is going to be phased in gradually, starting in 2025. Okay. And it's designed to reduce that tax rate on capital gains.
On capital gains.
From selling
shares.
So it's a special capital gains break.
Special break.
For entrepreneurs.
For entrepreneurs.
Okay, how does it work? So the CEI will reduce the inclusion rate to half the prevailing rate.
Okay.
On up to $2 million of capital gains over a lifetime.
Over a lifetime. Okay, but are there conditions?
There are a few conditions.
Okay.
Lifetime limit.
Yeah.
It's going to be phased in gradually.
Okay.
Starting at $400,000 in 2025.
Right.
And increasing each year.
Until it hits that $2 million.
Until it hits $2 million in 2029.
2029. Okay, so keep those timelines in mind.
Keep those in mind.
If you're planning an exit?
If you're planning an exit, yeah.
Okay, and the second incentive?
The second incentive is for employee ownership trusts.
Employee ownership trusts.
Or EOTs.
EOTs, okay.
These are trusts designed to hold shares of a corporation for the benefit of the employees.
So it's a way to facilitate
employee
ownership of a business.
Of the business.
I love that.
It's a great concept.
Are there any tax advantages?
There is a big one.
Okay.
The first $10 million in capital gains
from selling to an EOT.
Are
exempt.
Exempt from tax.
Wow, that's big.
It's a big one.
Okay, so are there any rules around this?
Of course, there are always rules.
Always rules.
The key thing to remember is that $10 million exemption, it applies to the business as a whole, not to each shareholder.
Okay, so if you've got multiple shareholders?
You got to figure out how to allocate that amongst themselves.
Okay, so EOTs.
EOTs.
Definitely something to explore.
Definitely worth exploring.
All right. I feel like we've just gone through
a lot of information.
A ton of information.
We have.
Covering everything from investors,
homeowners,
families, business owners. My notebook is
full of strategies. That's what we want.
Yeah.
We want you to feel equipped.
I feel much more equipped.
To make those decisions.
Yeah, to tackle my own tax planning.
That's the goal.
Yeah. So let's just distill this down.
Distill it down.
To the essentials. What are the big takeaways?
The big takeaways
for our listeners.
Well, I think the first one is something we've been emphasizing throughout this whole deep dive.
Okay.
Timing is everything.
Timing.
Whether it's realizing capital gains, making RRSP contributions, or deciding when to take those withdrawals.
It all matters.
The
decisions you make now.
Can
really impact your tax bill.
They can.
So be proactive. Be strategic. And know those deadlines.
Deadlines.
December 31st is coming up fast.
That is.
And it's a make or break date.
Make or break.
For a lot of these strategies.
A lot of them.
So don't procrastinate.
Let's wait. Get it done. Another key takeaway, I think, for me. Is that everyone is different.
There's
no one-size-fits-all approach.
No, one size fits all.
Tax planning. Absolutely what works for one person
might not work for another. So it's crucial to get advice
from those professionals.
Tax and legal professionals.
Who can look at your specific situation. And your goals.
And come up with a plan that's right for you.
Exactly.
So if there's one piece of advice we can really emphasize here. Don't go it alone. Get help.
Get the help you need.
To make those informed decisions.
Absolutely.
All right. As we
wrapping up,
I want to leave our listeners with a question.
Okay.
To ponder. Given all the possibilities we've talked about today. What is your top priority?
What's your top priority?
For year-end tax planning.
What matters most to you right now?
Is it minimizing your tax bill?
Minimizing that bill.
In the short term. Or is it maximizing your retirement savings?
That long-term view.
For the long haul.
Maybe
it's about supporting your family.
Think
about what's really driving
those decisions.
Your financial decisions. We'd love to hear your thoughts.
Share them with us.
Share your insights.
Your questions.
Your aha moments.
With us.
On social media.
On the
website.
We're all about
building that community.
A community of informed and empowered
individuals.
It's been a pleasure.
Pleasure.
Diving deep into these topics with you.
With everyone.
And remember, tax planning might not be the most glamorous topic.
Not glamorous.
But it's a powerful way.
To
take control. Of your finances.
Until next time.
Happy planning.
Okay, so we're back wrapping up our deep dive on year-end tax tips for 2024.
Yeah, it's been quite the deep dive.
It has. Lots to consider.
There is.
So before we go, let's try to distill everything down. Into the essentials. What are those big takeaways?
Well, I think the first one that comes to mind is what we've been saying all along, really.
Yeah.
Timing is everything.
It's crucial.
Whether it's, realizing those capital gains.
Yeah, making those RRS key contributions.
Deciding when to take withdrawals.
All those decisions we make now can really impact
that tax bill.
Yeah, so we have to be proactive.
Proactive.
And strategic.
Strategic.
With our planning.
Absolutely.
And of course,
Reload.
those deadlines.
Deadlines.
December 31st is coming up fast.
Don't want to miss those deadlines.
It's a make or break date. For a lot of these strategies we talked about.
It is.
So don't wait.
Don't procrastinate.
Get it done.
Get it done.
And I think another key takeaway for me from all of this is everyone's situation is different.
Everyone's different.
There's no one-size-fits-all approach.
No one-size-fits-all.
When it comes to taxes.
Absolutely not.
So what works for one person might not work for another.
It might not.
So it's so important.
It's so important.
To get advice.
Get that advice.
From the experts.
Facts and legal experts.
That can look at your situation.
Your specific situation.
Your goals.
Your goals.
And tailor a plan that's right for you.
That's right for you.
Yeah. So if there's one piece of advice.
I
think we can really hammer home here.
Yeah.
It's don't try to do this alone.
Don't go it alone.
Get the help you need.
Get the help.
To make those informed decisions.
To make the right decisions.
All right. Well, as we wrap up here, I want to leave our listeners with a question to ponder.
Okay.
Given all the possibilities we've talked about today.
All the possibilities.
What is your top priority?
What's your top priority?
For year-end tax planning.
Yeah. What matters most right now?
Is it minimizing your tax bill in the short term?
The short term.
Or maximizing those retirement savings.
For the long haul.
For the long haul.
Yeah.
Or maybe it's about, supporting your family.
Supporting your family.
Think about what's really driving those decisions.
Driving those financial decisions.
We'd love to hear from you.
We will.
Share your insights.
Your questions.
Your aha moments.
On social media.
On
our website.
We'd love to hear from you.
We're all about building that community. Of informed and empowered individuals.
Informed individuals.
It's been a pleasure diving deep.
Into
these topics with everyone.
Absolutely.
And remember, tax planning might not be
the most glamorous topic, but it is a powerful way. To take control of your finances.
To take control.
Until next time, happy planning.
Happy planning, everyone.